Continuing our research on the list of 10 companies we got, next stop is Adobe. They are a software company based in the US and founded in 1982. Their flagship product is Creative Cloud, a subscription service that allows members to access its creative products. You probably have heard about their software like Photoshop, Acrobat, After Effects, and so on. They have grown their revenue from 4.4 to 18.4 billion in the past 10 years. Most of their revenue is from digital media segment and half of their revenue is inside US. So they have so much room to grow. They have a good margin on their income and free cash flow, and it has been growing in the past years too. The same goes for their return on employed capital, which sits around 30%, which is impressive. If we look at their balance sheet, we can see they have low debt compared to their growing equity, which is good, and they have more cash than their debt, which is also positive. And their whole debt is like 1 year of earnings, so they can easily pay it down if needed. They have a high amount of goodwill on their asset, which is probably because of them buying other businesses, which can be bad if they have overpaid. But they won't have an issue with their current ratio being higher than 1 and their healthy and growing free cash flow. And if you are wondering about the tool I'm using, this is Simply Wall Street. It's a great product with access to more than 50,000 companies in 90 countries all over the world. You can check financial info, news, valuation, dividend, shareholder structure, and much more. I have their unlimited account, which costs $20 per month, but if you use the link in the description below, you can get 40% off with a 14-day free trial period, which makes it a no-brainer. So make sure to test it out. Thank you, Simply Wall Street, for their great offer. Now let's get back to Adobe. They only need to spend 5% of their cash from operating activities on CapEx, which is pretty awesome, and they mainly use their cash to buy back shares, which you know I love, if done at a reasonable price. They have been lowering their number of shares outstanding constantly in the recent years. Their stock-based compensation is not crazy high, sitting at around 20%, which is not great, but not bad either. So we like what they do. They have loyal customers depending on them and their subscription service, which will bring in recurring revenue. We like their consistency of growth. They are a bit overvalued right now with real free cash flow of 6 billion and valuation of 240 billion. So we will add them to our watch list and wait for the price to come down a little bit. It has gone a little bit high with the hype around AI. Thank you for watching this video. Hope you enjoyed it. If you did, make sure to tap the like button for the YouTube algorithm, subscribe to the channel if you have not done so already, and tap the bell button to get notifications whenever I post a new video. Check out Simply Wall Street offer, link in the description below, and try it out. And next, watch this video for a closer look at Badu. Have a great rest of the day and see you on the next one.